So I recently spoke at the London Prop Expo, and I talked a lot about how one-to-one risk reward can really help a new trader or fix any trader's psychology. I also went into data collection, but I spoke as well about discretionary versus mechanical trading and the benefits of a mechanical system. Now the speech was well received, but it also did spark some debate. So I'm going to run through that presentation with you now, and I'd love to hear what you guys think in the comments. Hey guys, so a discretionary versus a mechanical trading system. Now what is the difference? Well, a system that is based on experience and judgment, that is discretionary. I've met many traders over the years that have years of experience, 30, 40 years of experience in the markets. And they can tell you largely where the market is going on any given day. They can probably be right 75% of the time, but it comes from intuition. It comes from years of experience. Those type of traders are not the best mentors in the world. The reason being is because their systems are based on their experience, and to teach that experience to a new trader is almost impossible. Now, as a mentor myself, the solution for me here is to teach a mechanical system. And a mechanical system is just technical analysis applied systematically. Now, what do we mean by technical analysis applied systematically? We mean that the technical analysis that we place on the charts has a tick box process to provide an entry into the market. So when we put, for example, an area of supply and demand, I'm a supply and demand trader. So when we identify an area of supply in the market, we need a checkbox process that we go through when the market enters that area of supply. We're not using intuition. We're not using subjectivity. We're just applying a tick box process to either take the trade or not take it. If it doesn't fit the criteria, if all the boxes aren't ticked, then we don't take the trade. Why do most traders struggle with a discretionary system? Because of experience. We can all become discretionary traders over 10 years in the markets of watching market behavior, learning instruments, watching how they move, trading through varying market cycles. We can understand that maybe the NASDAQ moves a certain way at the US Open because we've watched it for years on end, and we get good intuition. But that often can't be explained. It can't be taught, and it's just because it comes through time. The solution for me here is to go back to that technical analysis applied systematically, a mechanical system, and that's exactly what I teach. The rule-based system, there's minimal subjectivity, and it is backed by data. Okay, so what's an example of a subjective question? Well, I see a lot of traders with systems that have a weekly bias or a daily bias. This isn't something I ever implement into my trading because my bias can be wrong. And if I'm tied to a weekly bias for the whole week and I've got that bias wrong, then I'm going to be wrong the whole week. I'm not adapting to what the market's telling me. If I'm trading a bias, then I'm trading the market as I am, not as the market is. I need to trade what's in front of me. It needs to be backed by a mechanical process and data, and I need to execute it emotionlessly. But if I have to form a bias, I'm going to question myself. It's not going to give me conviction. Two traders could look at this market, for example, in opposing ways. One may look at this market as we formed this big inversion here. We formed this big spike of liquidity and a drop, what you would call classically a hammer candle or an inverted hammer candle. And on the weekly, that may tell us, right, we're bearish because this market formed that huge rejection. Whereas we may have other traders that are looking back 5 weeks ago and they're looking at this big bullish engulfing candle and they're saying, right, any pullbacks we want to long. Well, those two traders, they're not necessarily wrong. There is no right or wrong. The market is going to do what the market's going to do. It's a completely uncertain environment. So we have to try to find patterns and predictability in an uncertain environment. But if we're using a bias, like a discretionary bias, how do we track that? That becomes very difficult to quantify in terms of data. And if we start getting the bias wrong, say 4 weeks out of 5, then our intuition is bad. But we don't have really anywhere to go with that system. How do we reverse engineer that? How do we fix that? It becomes very difficult. The other thing is you may have a weekly bias like this on this chart, for example, and you may say, okay, I'm bearish because of this big rejection. And last week we had a bearish engulfing candle. Then we go down to the daily and you may say, well, actually I'm bullish. We had this big bullish run here. We haven't broken that leg of structure. So there's no confirmed trend change. Overall, this market looks like it wants to take the high and go up. So there are all these discretionary elements to these systems. And I see so many new traders that struggle with these elements. The other thing is, if you've got a mentor that has discretionary elements to their system, they can hide behind that. So when a trade doesn't come in, they can easily say, well, I didn't take that one because it didn't fit this, it didn't fit X, Y, and Z. When from your perspective, it was everything that they teach. The issue is, because there's subjectivity and discretion in the system, and I see it all the time with YouTube traders in particular, they'll go through a trade recap and there are so many variables. There is no way anyone could learn from that particular trader because all those variables change, and they change every video. One video they're trading a certain ICT method, and then the next video they're using one of his other concepts completely differently to trade. I'm not a massive fan of ICT, as you probably know if you guys have followed me for a while. My system is way more simple. It's just supply and demand with cross-asset alignment. There's a PDF under this video, if you haven't downloaded it already, that goes through how we use multiple assets and multiple instruments to determine our areas of supply and demand in the market. And this, for me, is the missing link of the majority of retail traders' systems. Now, I touched on it a bit there, but data is the other massive part of this. If we have a discretionary system, everything becomes very difficult to quantify. So let's go back to maybe an ICT example. If you have all these variables within your edge, how do you quantify them? How do you figure out what's working and what's not? Because our goal as traders is simply to do more of what works and less of what doesn't. And we quantify that here in a spreadsheet. I use Notion, for example, and I log every trade. This is every trade this year so far. And I determine what's working at the end of the quarter, what isn't. I do more of what is, less of what isn't. It's as simple as that. There are other traders out there with systems like they use EMAs, fibs, trend lines, and levels, right? So let's say they use a 38, a 50, and a 618 fib, and they use a 50, 100, 200 moving average, and they're stacking confluences at levels. I've seen that a lot from traders, and I've also experimented with that myself in previous years. But the issue is there's so many combinations of confluences that it's very, very difficult to find what works. For example, is it a 38 fib with a key level that works the best? Or is it a 50 fib with a 200 EMA that works the best? Or is it a trend line with trend, a pullback to 38 fib and an area of support that works best? There are all these variables, and what you'll find is each instrument performs completely differently. So something like gold tends to work very well on fib retracements, whereas something like US dollar CAD responds really well to a trend line, let's say. It becomes very, very difficult to trade that way. There's so many variables to track, and I'm not saying you can't do it because you can track those variables, but it's much more simple for me to just trade supply and demand across a small number of instruments. You know, we look at metals, I look at indices, and I look at euro, dollar, pound, dollar. That's it. That's currently my playbook. And some of my mentees branch out into other stuff. They'll look at the Aussie dollar, US dollar, New Zealand dollar, US dollar. You know, they're using the FX majors. Maybe some also use some other metals, platinum, silver. Some of them will trade the DAX, the German 30, German 40, the FTSE. You know, there are all these other instruments that you can bring in. But we're just trading the same concept on all of them. It's supply and supply and demand leaves its footprints in the markets, and it works. It works on its own, but if you combine cross-asset alignment with it, it pushes the win rate to absurd numbers. I'm not even going to show you guys the win rate here for the year so far because it's getting to numbers that don't seem possible, and I'm really expecting that to come down. I don't like to push stuff that's unrealistic, but equally, using cross-asset alignment, our win rate is massively high at the moment. And if that changes, if it drops to nearer 50% at one-to-one risk reward, then we're starting to lose our edge. And that's where we dive into this data and we figure out, you know, what's going on here? Why is this dropping? Is it because we're using the wrong parameters? Is it because we're trading a certain session time that's not working well for us? Are we using too wide a stop, too tight a stop? Are we expecting too much risk reward? Do we need to go back to those base hits of one-to-ones? And that's going to be in my next video, just talking about the fact that that's what transformed my trading, going for those base hits, those singles, not trying to hit the home run every single trade. And a big part of all of this and what I presented at the Prop Trading Expo was that I choose win rate over risk reward, and I receive a lot of backlash for that. So I get a lot of people tell me that what I'm doing is completely wrong. All the textbooks tell you that you need to push higher risk reward, lower win rate. All the best traders in history have done that. For me, I can only speak on experience. That doesn't work. For me, I need a high win rate. Whether it's for my psychology or whether that's just for my P&L, both prove that my higher win rate, I'm a more successful trader. And if I start trying to push the risk reward, my P&L doesn't increase. And realistically, there are just two types of edge. One is a high win rate, low risk reward. So that's what I trade. Low risk reward, high win rate. I commonly go for one-to-ones. Maybe I push the odd trade with a runner and stuff, but one-to-one is my base hit. That's my starting point. And the other is a low win rate, high risk reward. So that's going for your 1-to-3s, 1-to-5s. I've known traders that have an average of 1-to-12 with a 20-something% win rate. I personally can't operate like that. They're psychologically sound. They know exactly what they're doing. I struggle. But the biggest factor with all of this is the max consecutive losses. And it amazes me how many traders don't know their number of max consecutive losses. So you may know your system. You may know exactly what you're looking for to take a trade. You may have all these tick boxes that you need to address or you need to tick before you enter the market. And you may know that system inside out. But the main thing you need to know about your system is the win rate and the max consecutive losses or the average consecutive losses that you're going to face at any one time as a trader. Now, this system here is just showing Monte Carlo simulation of a 30% strike rate, so 30% winner at 1-to-5 risk reward. The max in this Monte Carlo simulation of losses was 42 in a row. That's absurd because this is a huge data set. But if we just take the average here with a 30% strike rate, your average consecutive losses is 17. Now, I don't know many traders, especially new traders, that can sit through 17 losses and just continuously execute their system without any kind of psychological issues. I've traded for a long time and I can't execute a system like that. It would demoralize me. I would start self-sabotaging. I would start tweaking the strategy, questioning what I'm doing, and ultimately probably quit trading. Now, if you look at the results of this system, this risk reward system with a 1-to-5R, and you're getting, say, 10 trades a month, so total trades in 12 months, 120 trades. If we don't compound that and we just risk 1% a trade, this system will generate a 96% return. At 0.5% risk per trade, 50%, so 48% in 12 months. It's a phenomenal system. It works incredibly well. But how good do you have to be psychologically to be able to execute through those 17 consecutive losses? Let's compare that with a system that I use. Now, a system that I use, this is at 1-to-1.5 risk reward. Now, I typically use 1-to-1, so I don't use 1-to-1.5, but for the sake of this example, at 75% win rate, if we look at the exact same figures here, if our risk reward is 1-to-1.5, 10 trades a month, so 120 over the course of the year, and we risk 1% a trade, that's 105% return in 12 months. So it's actually beaten the previous system, even though the other system's risk reward was 1-to-5. If we actually look, though, at the consecutive losses here, we're only facing 4.7 on average. Max was 10. So our average consecutive losses are 5. The brand new trader is going to be able to sit through 5 losses. They may struggle even, in fact, but there's more chance that they're going to be able to sit through 5 consecutive losses over 13, over 17, or whatever the last system was. It's way too high. And that's why, for me, teaching new traders and also teaching traders that are experienced but struggle with the psychology. I'm teaching a trader at the moment who's very, very experienced, but they still struggle with the psychology of losing. If you build a system with a high win rate, lower risk reward, that will fix their psychology. They will start to get conviction in the edge. Because the trader builds confidence from seeing the system work. That's how we start to understand that we have an edge in the market. If we don't have any conviction, if we don't have any data, our execution is going to be off. We're not going to be executing as we should be, and therefore we're not going to be profiting and we're not going to be successful as a trader. The other massive thing with this is a lot of the people that I teach that want to learn to trade or that are getting into trading now, they're pursuing these prop firms, retail simulated capital prop firms. And prop firms have drawdown thresholds, drawdown parameters, max daily losses, max overall losses. Some of them have trailing drawdown. All of these things hold the trader back because these prop challenges obviously are designed for us to fail. And failing a prop challenge doesn't mean you're a bad trader. I know traders that can't pass prop challenges that have really low win rates, high risk reward, and they're massively profitable. but they're not necessarily good prop traders because the retail simulated prop firm environment is designed for us to fail. But the higher win rate strategies perform way better than the higher risk reward strategies within the prop environment, because you're less likely to hit those consecutive losses, and therefore you're less likely to go over those daily or overall drawdown thresholds that you're not allowed to hit. It's also much easier psychologically for the trader to hit winning streaks with a lower win rate on the prop challenge, build a buffer, build some equity, and start getting on a roll. Again, this builds conviction in the system. Now, I'm not saying that one system is better than the other. What I'm saying is that 1-to-1 or 1-to-1.5, the lower risk reward, higher win rate systems work best for me. They've worked better for me than any other trading system over the years, and I see it every single day with my mentees. They trade far better with a higher win rate, low risk reward system. So I really encourage you guys to explore it. You may have opposing views. I'd love to hear them below. Equally, if you feel like discretionary trading is easier to teach than what I've said, then comment below. I'd love to hear about it.